And the reason this is happening is we are experiencing a major financial shock.
Hey guys, welcome back to Library of Wealth. In today's video, we have the CEO of ARK Invest, Cathie Wood, giving us a market breakdown and an update about her outlook on cryptocurrency. Wood believes the economic indicators all point to a recession, with deflation and negative prices coming in the last few months of the year. She'll go over Bitcoin and how the price fluctuations will affect the asset class, as well as the inflection points the Fed will need to pivot on. Cathie believes we're living in unprecedented times as we wait for interest rates and inflation to go down. Economic activity in China and Europe seems to be having a significant impact on the United States. Let's check out part 1 and 2 of these interviews with Cathie Wood as she gives us her market predictions for the next few months. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
And if we're right and the Fed's close to pivoting, whether in rhetoric or otherwise, and they have a lot of reasons to pivot, even more now after the LDI crisis in Europe, we may have something similar going on here in the United States. And we also have big deflation in the pipeline. Just one commodity price after another has been capitulating. And so that's at the beginning of the pipeline. And then at the end of the pipeline, we have inventories overwhelming companies. And we have a consumer that is not playing ball as much as he or she was before. So we think this holiday season is going to be quite tough and is going to include a lot of discounting. We believe that the Fed is going to be quite surprised at the deflationary pressures that start hitting the headline inflation numbers during the next 3 to 6 months.
So, Cathie, are you anticipating an actual pivot or a pause? Does that happen sometime next year after what you say may be a rough holiday season? I mean, even though the Fed has said that they remain determined, they need to see more of this. Do you think that that's possible?
I think that the Fed is looking not just at the economy now, which is pretty weak. And if you combine that with the notion that our major trading partners are in recession, I'm sure they're on guard. But there are also signs that there's distress out there in the financial services sector. We've been watching the credit default swaps of money center banks doubling and tripling. And you know, in Europe, they're out to all-time highs. And so there are stresses and strains in the financial system that I believe have begun to show themselves, first with the LDI crisis in the UK. And the reason this is happening is we are experiencing a major financial shock. If you look at, Volcker is, Chairman Powell is invoking Volcker's name and his Keeping at It book title because I think Chairman Powell thinks we have an inflation like we had in the 70s, 80s. Chairman Volcker increased interest rates from 10 to 20% in an inflationary environment. That's twofold. Chairman Powell and team have increased interest rates 13-fold from their lows. And we believe when history books are written, that economists will be looking back at this saying, wow, what a shock to the system. And so I believe credit default swaps are going up for a reason, and we will find out what those reasons are over time.
Cathie believes the Federal Reserve is making a huge mistake with their monetary policy and thinks that more pain is coming for the housing, credit, and crypto markets in the coming months. Wood believes the drastic actions by the Federal Reserve are crashing the market, but says that these actions are resulting in suppressed pricing, which provide the savvy investor with substantial investing possibilities.
It's very interesting to hear people saying that we'll be able to skirt recession. We believe we are in a recession. The durable goods orders we just saw, really we're seeing the strength there because of activity being attracted to the U.S., a flight to safety. That's why our dollar's been going up as well. Nonetheless, we think we are in a recession. We're seeing tremendous demand destruction. You see demand for gasoline over the summer down to 25-year lows, 1997. Think about that. So lots of demand destruction, and we believe it will continue. The good news here is to hear Michael Evans this morning talking about, hey, we're all on the same page. This could be done in the first 3 months of next year. Well, if the market is the discounting mechanism that it should be, then it should be discounting the peak in interest rates. Yes, inflation peaked. We believe core inflation peaked at 5.3%. This is the PCE deflator that the Fed supposedly pays the most attention to, 5.3 in February. It's down to 4.6. And with all of the price declines that we are seeing out there, whether it's in retail because of too much inventory or way up the pipeline with commodities really falling out of bed, all of them, we think the inflation rate is going to be surprisingly low. We would not be surprised to see deflation month to month sequentially for a number of months during the next 6 months. I do think we're looking at a major pivot. If we're right that deflation, and we've been saying this for a while, so consider the source, but if we're right that deflation, both for cyclical reasons and for secular reasons, all we do is look at technology and the cost declines associated with different technologies, and they're massive. So we think that inflation during the years ahead is going to surprise significantly on the low side of expectations. Well, I think they have been basing their outlook and their policy on two lagging indicators. Seems they've been paying more attention to the CPI year over year, which is still at over 8%, and employment. Both of those are lagging indicators. The leading indicators, which are all in the pipeline, easy to see right now, are all saying that prices are going to come down. Inflation certainly will come down, but I think the big surprise out there is the number of months we will see actual deflation, negative prices. And it's not just because of the U.S. In fact, we're benefiting from the flight to safety from the rest of the world. What's going on in China is highly deflationary. What's going on in Europe, the same. This energy is a huge tax on that continent. One of the other things that's happened in the last in the last week that I think is fascinating is that both Japan and China have basically supported their currency, and they're basically saying no mas. And in order to do that, what are they doing? They're selling dollars and buying their own currency. So effectively, China and Japan are doing some of the easing that we think the Fed will do, increasing dollars in the system.
Wood believes the Fed rates will decrease, but says it's currently showing signs of extreme weakness. Along with the household employment charts being down for the last 4 months, Wood has never seen a swifter increase of the bottom. Many people haven't realized we've gone up about 50% from the previous lows. Wood believes that we are currently moving into a serious recession. The only difference is we don't have access to the systematic excesses like in the pre-08-09 mortgage market. Wood says that the ongoing decline is partly due to China beginning to unwind from this cyclical point of view. She says that the Fed doesn't care what happens to the economy now, and they're overly focused on inflation. If Wood's interpretation of deflation as cyclical is correct, the coming deflation will actually be a good environment for the financial market's growth. What do you guys think about Cathie Wood's market outlook for this year and how the Fed is handling inflation indicators? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.